Hello, I'm Ryan Ziegler and I'm here to talk about low volatility on the LME and range-bound copper prices. Late last year, LME metals slid lower on fears over the US-China trade talks. This year we saw a short covering rally in January and hopes that there'd be a good end to the trade talks, but the talks have carried on and copper especially has been stuck in a tight range either side of 6,400. If we look at the first chart, we can see it's not just copper prices which have been stuck there since Chinese New Year, but because of the ARB, LME, COMEX and Shanghai copper prices have all been stuck in similar ranges. Now, the tightness in the price range has also impacted volatility. Realised price vol has really fallen. If we look at the next chart, it shows copper prices in red and in historical vol in green. And the historical vol has fallen, and it's also put pressure on implied volatility, which is important because it's implied volatility which determines the price of options. Now, option pricing is important, especially for professional option traders who don't trade price direction, but they do trade the difference between implied volatility and realised price volatility. For example, if an option trader believes that implied volatility is too cheap, he'll buy options, and that gives him a long gamma position. So he's a seller in a rally and a buyer in a price fall. Contrarily, if an option trader believes that implied volatility is too expensive, he'll sell options, and that'll force him to be a buyer in a rally and a seller in a price fall. And that's going to cost him money and eat into his option premium. If we zoom in on the next chart, which is a zoom in of the previous chart, we see that here, this shows an option long, and it shows him selling gamma, which is selling futures when the price rises, and then buying back the gamma when the price falls. Now, because of the tight price range, his opportunities to trade that gamma and earn back his option premium have been very limited in the last couple of months, and so implied volatilities have been marked down lower. Now, it's not just the nearby vols that have been marked down lower, but implied vols have been marked down lower across the curve. If we look at the next chart, it shows implied volatility for 3-month, 6-month and 12-month copper vol at the money, and you can see it's been sliding down lower all year. Now, if it sounds quite boring, a tight price range on copper and sliding implied vols, but for copper producers or copper longs who are worried about the resolution of the Chinese trade talks and worried as well of the impact globally, and weaker European figures suggest that it's a bit of contagion. There's worries about the global economy on the back of the China's-US spat. Then if we consider for copper producer who's looking for protection on the downside, the following chart shows the cost of put options, a $5,800 put option, 1 year forward, and their costing premium over the last few months. Now, at the end of last year, early this year, that option would have cost around $400 a tonne. And because of the price rally, it's been up about $500 above the low at the end of last year, and also the fall in implied volatility, that option now is less than $200 per tonne. So for any copper longs out there, either producers or speculators who are looking for cheap downside option protection, basis the short covering rally in January and the fall in implied vols, now might be a good time to look at buying downside option protection if you're bearish for these talks. Thank you and good trading.